Most people think they're bad with money, but what if I told you you've been following a playbook your entire life? A playbook designed by the bank. And it's not illegal, it's not evil, it's just business. Today we're breaking down the bank's playbook to keep you broke, and more importantly, how to get out of it. Hi everyone, welcome back to Financial Survival. If you're new here, my name is Carrie. On this channel, we talk about money, retirement, real life, and how to stop feeling financially squeezed. And today, we're talking about the system that quietly trains you to live in debt. Let's get into it. Banks are businesses. Banks are not charities. They are businesses. Their job is to make money for shareholders, and they are very, very good at it. Here's how it works. They take deposits from customers. They pay those customers a small amount of interest. Then they lend out that same money to those who are looking to put a mortgage on a home, finance a vehicle, pay for a new equipment, or pay for school. They lend out that same money at a much higher rate. That's the spread. That's the business. It's simple. But the genius of the system is this. Most clients don't start with big loans, but that's the part of the bank's playbook. Start small, get comfortable, then commit to long-term and to large loans. Step 1, overdraft protection. Usually your first bank account is opened as a minor. Join with a parent because your parent has a good relationship with the bank. The bank suggests, why don't we add overdraft protection? Sounds helpful, right? If there's a purchase that's slightly over your balance, it will still go through. How kind. But here's what really happens. You overdraft, immediate $10 fee, 25 interest on the overdrawn amount, and yes, interest is on the fee too. It's your first taste of credit. It's small, it feels harmless. That's the point. Step 2, the credit card. You're still in high school and suddenly, would you like to start building your credit? They offer you a $1,000 student card. No perks, no rewards, just building your credit. Then the system watches. If you use it responsibly, congratulations, you qualify for an upgrade. Higher limit, travel rewards, annual fee, higher interest rate. Here's something I've always found interesting. The bank sends your statement every 30 days, but they start charging interest after 21 days. Why? Because statistically, they know many people won't pay it off in time. That's not accidental, that's math. Step 3, student loans. You graduate high school, you go to college, and suddenly education isn't free anymore. Public school didn't prepare you for that cost shock. Enter the bank, we can help, and they do. Now you start your adult life, not with savings, but with payments. Before your first real job, before your first home, before your first big financial decision, you owe money. That's powerful. Step 4, the car loan. You're working now, making adult money, and the new car looks good. The bank will finance it for 7 years. 7 years? Here's the problem. Cars drop in value quickly. The first 5 to 6 years, you often owe more than the vehicle is worth. So you're paying interest on something that's losing value every single day. That's not wealth building, that's wealth draining. Step number 5, the mortgage. Now we get to the big one, mortgages. It's almost impossible to buy a home without one, and banks know that. Let's use simple math. You borrow $500,000 at 5%. That's $25,000 in interest the first year alone. If your payment is $2,500 a month, that's $30,000 per year. $25,000 of it goes to interest. Only $5,000 reduces your actual debt. Now multiply that across thousands of homes. That's why banks aggressively market mortgages. And remember, if you stop paying, they take the house. The bank is always paid first. Step 6, the HELOC. You've paid down your mortgage, you have equity, and the bank says, why not use the value of your home to renovate? Home equity line of credit. It feels smart, it feels strategic, but it's just more interest flowing back to the bank. You worked hard to build equity, now you're turning it back into debt. None of these things are bad by themselves. Overdraft, credit cards, student loans, car loans, mortgages, HELOCs, individually, they can all serve a purpose. The issue is stacking them. If you're paying interest on a credit card, car loan, a student loan, a mortgage, a HELOC, at the same time, the bank is getting richer faster than you are. So how do you break the playbook? This is where it gets simple, not easy. Save first. Use money you have on hand Do not rely on the loan to make the purchase. Wait until you can afford the car, house, or anything else before committing to buy it. Don't finance lifestyle. Think twice before committing to long-term debt. When you sign a loan, you're under contract. You owe the principal and the interest. The bank doesn't forget, and they don't forgive. The bank playbook works because it's normal. Everyone does it. It's socially accepted. It's encouraged. But wealth is built by owning things outright, not by financing everything. If you can learn to wait, if you can learn to save, if you can learn to question every loan, you stop playing their game and you start playing yours. If this helped you see money differently, hit subscribe, because on this channel, we don't just talk about money, we talk about surviving financially in a system designed to profit from your habits. Let me know in the comments which step of the bank playbook have you experienced, and which one are you working on to break free from. I'll see you in the next video.